Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, May 6, 2020. It is 12:26 p.m. Eastern Time as I'm starting the video. We're going to cover a few different things in this video. I didn't post a morning update today because there was absolutely nothing to post or update, since the previous market wrap at the end of the day, as well as what was going on intraday. I posted a couple of static charts throughout the day, chart images. Yeah, this is where I'm zooming in real tight. That's where we closed yesterday on SPY. That's where we opened today. Very, very tight range. And so, pretty much the futures went nowhere overnight. And so you don't have anything new to report. I'll save my time and everybody else's by, picking up and showing charts exactly where we closed yesterday. And we're still there, where markets are flat today. So we don't have any new developments today to report, but what I do want to do is go over some things that I haven't covered in a while. So we're going to start it out like this. We're going to take a quick look at the 60-minute charts of the major index ETFs. I'll include the Dow DIA, which tracks the Dow Industrials for those that trade that. And it's also a better proxy of the market than QQQ. We'll look at QQQ, and then we'll look at the equal-weighted NASDAQ 100 as well. Then I'm going to jump over to the weekly charts. Real quick overview of the big picture, look at the indexes there. And then jump down to the daily charts, and that's where I want to cover a few things, kind of stay consistent. We're going to look at a couple things on the daily time frame, a few trend indicators and other things, and we'll run through the indexes there, the S&P 500 sectors, and maybe some of the SPY holdings there as well. So quickly, nothing's happened on the 60-minute chart over the last few days. Here's that SPY other board that I have with the trade. We're bouncing around between these two gaps. Remember yesterday I said this is what we watch. Top of the gap, bulls need to take that out. Bottom of the gap, bears need to see that go. And that's roughly where that stop is. Like I said, strategically or tactically, I should say now, that should probably be raised just above this high right here, and I may do that today because again that's pretty significant gap resistance, and it's already been tested. It was tested all day yesterday, failed there with the impulsive red candle, so it's a big level. The bulls can pop it. There's other factors, and that's what I'm going to go through. That's why I don't look at just one index. We're going to look at a few, but for the most part, all other things being equal, that would be bullish. Near term, again, near term. It's not going to change any the longer term technicals. These divergences that were in place at this previous high before the wedge broke down, like I told you before, we just extend those lines. Any marginal new high right now will still be a divergent high, and so therefore it's not going to change much of the technical posture. Yes, you have to give credit anytime a previous reaction high has been taken out, but if it's a marginal new high, I often say this, that marginal new highs or breakouts to new highs that occur with negative divergences and while overbought or with overbought conditions have a much higher failure rate, and I'd say well over 50% chance that a breakout with those conditions to new highs or above a previous reaction high will fail. So cross that bridge if and when we get there, and until then, like I said, the very near-term levels, you got it right here between these two gaps. If this gap gets entered by a good amount from above right here, this gap with that low looks like a gap fill will be your most likely outcome there. Now let's look at a few other indexes here. Let's look at QQQ. NASDAQ 100, same story. You're flanked by gaps on both sides. That's why I have this purple line here. You have dual gaps right there, dual gap support. That's the top of both of those gaps. And we're also challenging that previous reaction high that we failed at yesterday. Remember, we traded there all day, had an impulsive leg down, came back, and the market continues to stall out above there. We had a couple failed attempts to break above it and hold above it, but as of now, we're still there, and to be continued. Again, you want to see a solid pop, a solid 60-minute close, well above that level. Again, due to the posture of these indicators, it's a breakout that I wouldn't take because that's just a rule I have. I'll take certain breakouts. In fact, most trade ideas here are based on breakouts, just not breakouts that occur with these long building negative divergences, because that has a much higher rate of failing. And again, you can just take the previous divergence line and extend it out, and that'll show that any new high will still be a divergent high anytime soon in the Qs. Interesting to note when you look at QQQ, we're testing those previous highs right there. Bigger picture, as I said, we're in a multi-week trading range here. If you really look at the bigger picture, it's the top of that one there. And again, QQQ, although it is an index technically speaking, it is the least representative index out there, especially for the popularly traded and watch ones. Now, I love trading it, but it's not remotely indicative of the U.S. economy. It's really a tech index, 50% technology, and even then you have just the five biggest stocks make up, over a quarter of the weighting in it. So it's really more of a proxy on how those the largest companies in the U.S. are doing, the market-leading FANG stocks, Facebook, Amazon, Alphabet, and those guys. They again make up a big part of it, and so they're not representative of the economy. You look at an index like the S&P 500 with 500 stocks among 11 sectors, or the Dow with 30 stocks, but better sector coverage. The Nasdaq 100 doesn't have financials, things like that, so it's not really, like I said, a diversified index. But if you trade it, because of the volatile nature of tech stocks or higher growth, they tend to rise higher. More when the market's going up, and also fall harder when the market's going down at most points in time. Now, if you want to take out the effect of those top heavy weightings from that FANG stocks, just to add an E to the end of the QQQ, and that gives you the Nasdaq 100 equal weighted ETF. And you can see, unlike the Qs, that one has failed to take out the previous high, and it's still well within its trading range. So again, that's just showing you that people are reverting to their old ways, buying the those companies in the elite $1 trillion club, or very close to it, and all those FANG stocks are either at just above $1 trillion, or just close enough to it in market cap. But that's it. That's the bigger picture. Gone nowhere. Let's not beat a dead horse. That's it. There's nothing new to report until any of those near-term levels get taken out. Let's see. I'll skip IWM. Oh, I told you I'd give you Dow, DIA. There's the Dow. It's the same story. It's consistent across the board. We have these divergences building, negative divergences right here, just like, and it was pointed out at the time, we had strong bullish divergences building into the lows. Back here to here, I said no more shorts. I didn't add any on the site, said I wouldn't short anything here. I said the risk reward is not favorable. In fact, we started adding longs here, both officially and unofficially. But that was when coming off a divergent low, and we were able to milk a good part of that. And this, now we have divergent highs, so it's wash, rinse, repeat stuff. We had a divergent high leading up to the highs here. This is where you look to get short, position short for swing trades. This is where you look to position long, cover shorts. And this is where, as we've been doing, and I know a lot of people, I haven't had time to catch up on all the comments on the front page. I see there's a lot from yesterday. I'll read through those when I get a chance, but this is it. It's a go nowhere sideways trading range. Patience pays. There are no guarantees that these swing shorts will pan out. Some already, are playing out well, and others are just kind of treading water for the time being. But again, the technical case is still there and hasn't been negated yet. By negated, if we start moving up, higher we move up here, burn through these divergences, that will negate or dampen, the bearish case. But as of now, it's still very much intact. Okay, let's jump out to the weekly time frame now. And what I want to look at here are a couple things. Let's look at the posture of the some of the key moving averages. In this case, I have just a 40-week moving average up on the weekly chart. That's the same as a 200-day. You have 5 calendar days in a week, so if you multiply 5 times 40, that would give you 200. So that's why the 40-week moving average on a weekly chart is the same as your 200-day, and it's a key moving average that a lot of traders watch. It helps to define bull and bear markets. The Dow is well shy of that, but I want to show you the S&P 500. Okay, that's just recently we went up and kissed it, and I'm going to show you what we did in the last bear market. So I'm still working off the the primary thesis or theory that this is a bear market rally, and that's just a typical level where we rally back to during bearish trends and get rejected. Just as we took it out here, we struggled with the 200 for weeks, couldn't take it out, and then the bottom fell out of the market once the bulls failed to take out that 200 or 40-week moving average solidly on a weekly closing basis. You can see that was the highest point we got above, but then they dumped by the end of the week, and that's when the market gave up the ghost, when they just saw capitulation. That bulls stopped trying, bears overtook it, and that's it. And back here you can see boom, 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 boom. It does a great job of defining bull and bear trends. And then let's just look back at the last bear market. Was 2007 to 2009. We will zoom back in a little bit and see what happened there. It's not much different from where we're at today. We took it out with conviction here. We had a correction, the first leg down. We came and back tested it. We actually took it out by just a little bit, but not much on a closing basis. You can see those candles. It's a weekly chart, all that really matters. And then finally, see that big red candle right here? Let me zoom in a little tighter. I know on the video sometimes you can't see all the detail here. So we tested it 1, 2, 3 weeks of testing it. On the 4th week, we had a pretty violent rejection. We got quite a bit above it, and see that's a pretty bearish event, because you get that far above it, you have the majority of long-side traders saying, "Great, we're clearly above the 40-week now, the 200-day moving average on the daily charts." If you were to flip over to the dailies, so that's where you probably had that final, we call it suck-in move. Last of the shorts capitulated, more longs piled in, and then the reversal is a very bearish event. So you look for things like this. That's also a bearish engulfing candlestick, and from there you can see that was it. Next week we traded down back below it all week, back tested it, failed, tested it again, failed with a red candle, meaning closed the week down towards the bottom, and that's it. The stock market never looked back, and from that point, that test of the 200-day, again, after the bear market was well underway, there was another 52% downside. So it doesn't mean that's going to play out, and I can tell you right now it's not going to play out exactly as it did back then, but trading is all about recognizing previous chart patterns, history, levels that act as support, resistance, whether it's a self-fulfilling prophecy or not. Traders look at these moving averages, and so far that's what we had. Now, I pointed out back then we tested it for 4 weeks, consecutive weeks. So we only had one test so far. We're below it now. Take it for what it's worth. But the point being, same thing I've been saying for weeks now, is that I just think the risk reward is not favorable to be long. It's more favorable to be short. You just have to be patient. Sometimes these things can take weeks or even months to play out. Maybe they don't play out. Maybe we take out that 40 week and keep going up, and that's it. There are no guarantees in trading. All you can do is put the odds in your favor and take objective entries. Use stops that are in line with your profit targets. Not 1-to-1, but ideally 3-to-1 or better risk reward ratios. Take those shots, and if you're using attractive risk reward ratios, you're going to get stopped out on a few. You're going to win a few, and overall you're going to make more money than you lose. That's the name of the game in the market. Now here's QQQ. QQQ has clearly taken out the 200-day EMA by a fair margin. But again, that is the nature of this beast, this volatile instrument. Concentrated, tech-heavy index. But again, it did the same thing, almost by the same margin, back in the initial bear market rally. This was the end of the bull market back in October 2007. That's where you can see when we broke the 40 week on a weekly closing basis, we didn't just limp on down through. We had a sharp leg down, ending and culminating right here in this low, and then we had the first big bear market rally. That was just a little kickback rally. This was your first major bear market rally, and it went well above the 40 week, and it was there for several weeks, actually a couple months it looks like, and then fell back below, tried to back test, took it a little bit, a week or two, but then failed again. So I just want to mention the Qs. That is more typical for it to get back above the 40 week because of its volatile nature. Everybody, after the first drop, everybody flocks back into the beloved names, just like back then. They called them the FANGs, F-A-N-G. I call it FAAMG because of the higher weighting in Microsoft and Netflix. But and again, it's almost an identical technical posture. Now when we look at you take out the impact of those market leading FANG stocks, if you look at the QQQE, or you can go to NDXE, that's the actual equal weighted index itself. QQQE is the ETF that tracks this index, and you can see really it's still flirting with that 40-week moving average, just as it was back then. You can see back in 2008 on that first bear market rally, we didn't get that much above it as we did in the NASDAQ 100 or QQQ, which again has a heavy weighting on those stocks. So just kind of wanted to point out those similarities to now and then, and say, look, only time will tell if those clamoring for new highs are going to be correct or those clamoring for new lows are going to be correct. Only time will tell. But as of now, by nearly every metric that I use, long-term charts, long-term metrics, things like that, the case can be made that this is nothing but a bear market rally. And of course, one could make the case that this is the beginning, start of a move to new highs and beyond. Just as this one was right here. But again, only time will tell which one's going to be right. And again, just to kind of loop back to what I've been talking about for months now, at no other point in time in history have I put such a weighting on my overall analysis using weighting in factoring in fundamental analysis, or in other words, the macro picture, as I have now. So that I just want to say that is very largely impacts my longer term outlook for the market. Near term, we're just going to have to keep watching those 60-minute charts, daily charts, try to figure out where we go. And and I'll probably make more of an effort to focus on individual stocks. If the market's going to continue to grind around this way, we can look at individual stocks, many of which have already started to turn down, and sectors, which I'm about to get to here. So let's jump over to the daily charts. Let's go back to SPY. Let's go to a daily time frame now, and look. Here's what I wanted to go over. Couple things. You can see down below, let me move this down, you can see this PPO turning down. PPO line, you have the PPO line, which is the orange line here, and then the signal line, also the 9 EMA, they call that the signal line. So when your PPO line crosses down below the signal line, that's a bearish crossover, and when it crosses above, that's a bullish crossover. You can see it right here. We're poised to cross. We started to turn down there, but we never crossed. And I've talked about this before. I don't like to use any single trend indicator as a standalone buy and sell signal, but it does when it aligns with other buy or sell signals, such as trend line breaks, support or resistance levels, rallies into resistance, key Fibonacci levels, moving averages. Then you also want to factor that in. And so what this histogram down here will show you right here, this is the PPO histogram. It's simply a visual representation of the differential, or the distance between these two lines. So when the PPO histogram crosses down below the zero line, this white horizontal line, that means these lines have crossed, and we call that a bearish crossover. So you can look back in time and see that last time we had a bullish crossover, and that's a buy signal, helps to confirm. Remember, I was looking at the bullish divergences down here, the breakout that we had among the falling wedges, trendline breaks and everything. That helped to confirm the buy signals that were highlighted back here right off the lows by crossing over to bullish. And back here, this was the last bearish crossover. That was the best shorting opportunity in decades. In fact, maybe the best shorting opportunity, for a bearish, for this indicator, quite possibly since, I don't know, going back maybe to the Great Depression. I have to look at 2008, some of the drops there. Either way, it was a darn good one. It came early on, and it told you all along trend was bearish right here. And then it said right there, hey, we had a bullish crossover. You may want to, if you haven't yet, cover your shorts and consider going long. And then you can look back in time. I'm going to do that here and just put a little line here. What you want to stay away from using PPO or the MACD as a trend indicator is when these lines are flat. And PPO is going to show separation better than a MACD. You can put a MACD up, but the lines tend to flatten out even more during big moves. So what I like to say is stay away from or take them with a grain of salt when volatility is very low. You're in these low grind trends, because what happens, the lines are so close, you're bouncing around that zero line, you tend to get whipsaw signals. What I like to look for are these clean hills, clean separation. You can see it better on the PPO, and then just put up so let's go back here. Okay, so you had a big green hill, and then boom, there was I'll put the crosshairs right where the sell signal was. You'd have to follow it up to the top. And you can see there was a nice dip in the market. It's kind of compressing prices here by pulling that up. But I'll box it in for you and show you. That was this drop. It was the biggest correction we had in a while, and it was certainly a nice correction to either get out of your longs or short it. And look where it went, right back to the 200-day moving average. And so again, you can go down the line, you can look at those right here, bearish crossover, and there's your sell signal that came right after on a break of the trend line. Biggest drop again in months. We had another one there, and it works the other way too. These green signals right here are buy signals. So I just want to point out that you can do this. I encourage you. Don't listen to me. Go through your own charts and go through. Learn to scrub these indicators. Stay away from the whippy, when the lines flatten out, look for these clean hills, and you will see that more often than not 100%, but more often than not, they're going to give you some pretty good buy and sell signals for trend or swing trades. And so that's what I'm looking at right now. We're getting close to those lines crossing. We don't have it yet. Let's look at the Dow. Same thing. You can see these lines are poised to what looks like an imminent cross. There are no guarantees, and you can see it here too, that PPO turning down. And this is a function of everything I've been talking about lately. You might say, well, how's the PPO turning down? The market's not far off its recent highs. Well, because remember, momentum works like this. It's like throwing a rock up into the air. You throw a rock up into the air and you toss it up. Do you see it go like this? I mean, technically it does that, but what it seems like, it goes up and it slows down. The rate of ascent slows down. It seems like the rock is suspended briefly, which technically it is. And then it comes down and starts building up speed on the way down. So what happens is this market was going up strong, but now it's stalled out. That's why the momentum indicators are turning down. That's what this tells you. The momentum is stalling out in this rally. And just like it was back here at the highs, and just like it was right here at the lows recently. So that's what I'm looking for. And again, there are no guarantees, but that's one thing that I'm on watch for here. If we get the bearish PPO crossover, especially solid red bar on the histogram, a follow-up one. Once in a while, you get some whipsaws, but again, the whipsaws tend to be, you don't tend to get as many when you have these clean separation, these big hills. This is what you usually get, is a strong trend followed by another strong trend followed by another strong trend in the opposite direction, of course. And even QQQ being the strongest of the indexes, again, for lack of a better word, is poised right now. It's not there yet, but it's rolling over. And when you look at QQQE, you can see it's even closer because, again, the equal weighted index has not come back up to that previous high, showing you that right now the market leading FANGs are doing most of the heavy lifting, whereas you're seeing deterioration in some of the the other 95 stocks in the NASDAQ 100. And if I didn't cover it, same thing on Dow. You can see right here, there's that pending. We'll watch for it. Pending means just or potential crossover, just like we had a potential Head and Shoulders the other day on the NASDAQ 100, but it never materialized. We never got what we were looking for. That's why some trade ideas I post on the site are posted as trade setups. A trade setup is not an actionable trade. It is a potential trade that would trigger an entry if and when a certain prices break out above a certain bullish or bearish chart pattern or key level. And sometimes those trade setups never materialize. They never trigger that buy or sell signal, and so therefore they were untriggered setups. And so that's the same thing here. We're watching for this, and we'll see. And again, it's not a be-all end-all. Now let's jump over to let's see here. Okay, let's run through quickly the sectors. There's 11 sectors that make up the S&P 500. So again, if you want the most accurate measure of both the stock market as a whole as well as the U.S. economy, then you want to look at the S&P 500. And I like to say any index is simply a sum of its parts. So if you add up those 11 sectors, now the thing about them is they're not equal weighted. That's very important to note. XLK is by far the largest sector at about a 25% weighting. So 1/4 of the performance comes from just one of those 11 sectors. So as I often say, until tech breaks, the market won't break. You want a good buy or sell signal on the stock market, wait for a buy or sell signal on XLK. And because it's tech and because of everything I've talked about and others, that for the most part, tech is much more immune to the shutdown and stay-at-home orders than many other sectors. REITs are getting pounded, energy is getting pounded for all those obvious reasons, whereas technology really doesn't affect their business model as much. And again, I'm generally speaking, but so that's why tech's been strong. Couple things as I run through these sectors real quick. You want to note a lot of them have some pretty well-defined trend lines. It really what comes across to me is a pattern of that we had a previous uptrend line off the lows on most, which was broken impulsively, and then we set up with a secondary trend line, which in some cases, such as this one, has already been broken as well. We had a breakdown recently in a back test. However, you can see we're pretty comfortably above the zero line on the PPO right now, although you can see which way the trend is going, that momentum has been stalling out, and that also gives you divergence on that PPO histogram right there. But it's something to watch for. So we don't have it yet, but we'll watch for a bearish crossover on the PPO there. And XLV, that's healthcare, you do have. So as I'm going through this, I'm going to give you, what we'll call check marks for sell signals. We have a bearish PPO crossover. Last time we had one was right here. Had you shorted XLV on that bearish PPO crossover, you would have been a very happy camper. History doesn't always repeat. Again, there are whipsaw signals even after some of the hills, like this one here. Here's a good example. There's a little whipsaw. You shorted it there. It didn't pay off. However, I wouldn't have shorted XLV here. You had a very clean, well-defined uptrend line. You could have waited to the break of the trend line, or we pushed up, made another divergent high. This is kind of like the indexes right now. We broke down from a rising wedge pattern except on the 60-minute time frame. They kicked back. They made a marginal new high, but they simply extended, or will, in the case of the indexes now, if they make a new high, will extend the previous divergences. Then you had a sell signal there, and that was the real deal. And that was also came with, right with a bearish crossover on the PPO. So these are things I'm looking at. Purple lines, if you see any on the daily charts, are significant levels. Here's a downtrend line to watch on XLV. Ideally bearish if it stays below it, bullish if it pops above that, and then there's a little resistance above. And that is the second largest sector at about 16% weighting. But again, we had a sell signal there, at least by that. Again, the reason I'm going through all 11 sectors is I wouldn't short the market if just one sector breaks down. You want to see the majority, especially these top sectors, breaking down. So far that's 1 for 2. Go to the next sector and weighting, that's XLF at about 11%, and that's the financials. No bearish PPO crossover yet, but close. We broke the trend line here. There's a key level. The financials, ideally, to keep the bearish scenario alive, should remain below 23.69. Any more downside, we're going to have a bearish PPO crossover. And also interesting to note that that zero line often acts as support or resistance, and right now that's where the PPO is starting to roll over, right on the back test of the zero line there. So that's what the financials look like. Won't give it a check mark yet, but maybe soon if we have a little more downside here. XLC been strong. Can't knock it. It's well above there. PPO is starting to flatten over. That's why the histogram's going down. But you have this secondary trend line. Like I said, this is a common theme among a lot of sectors. So this is the one to watch right now, I think, in XLC. We'll color that one up too. And then pretty big resistance overhead. XLY, consumer discretionary, poised for the bearish crossover. So this kind of goes along with the theme I was saying in yesterday's video on covering the 60-minute charts. We're really pushing the upper limits. There's a little more room for a little more upside, but we really, if we go much more than just a marginal new high on the indexes, it's going to start to chip away at the bearish case. But as of now, the charts really haven't changed in the last 3 weeks with that sideways trading range. And if anything, what's changed is these momentum indicators are starting to roll over and turn down and poised to make a crossover. Look, sometimes they kiss, meaning they come back in, these lines kiss and then bounce. And sometimes you get a little whipsaw signal too as well. And that's again evident back here. But you look, and a lot of times you get these clean, hill breaks right there. It tells you to go short. Tells you to go long there. It helps define those trends right there, and this is where you stay away from it when prices kind of flatten out like this. I like to use these trend indicators when we have these big price swings, when volatility is expanded. That's when they tend to shine. XLY, that was number 3. There's XLI, same story. So I can go through these over and over. We're rolling over right at about on a back test of the zero line. Poised to, but haven't yet crossed over. You can see a little evening star doji put in an XLI. That's the industrials, by the way. And so far prices have been moving lower. A little work to be done, but you can see a lot of sectors have started to roll over. It was also rejected at the 50-day exponential moving average. And there's XLP. If I don't mention it, I probably should have before. I have a confluence of key moving averages. I have a 200-day exponential, a 200-day simple moving average, a 50-day exponential, and I think I have this one turned down. It's a 20. That's a faster EMA for the right now on the daily chart. Let's focus on the 50 to 200s are the ones I'm watching. So there's XLP. It's already broken trend right here, and it's been stair-stepping lower. It has all the makings of a new downtrend, which is a security making a series of lower lows and lower highs. So far that's the case, a lower high and lower low. We'll see if that continues, and we also have a sell signal there. So again, I'm just looking at the sum of the parts here. Some of these are broken down. The ones that haven't, most of them look poised. Some are very close to triggering those sell signals on that trend indicator if we get any more downside. XLE, energy stocks, they were so beaten down. Energy's been in a bear market for years. I mean, the energy sector's it topped back in 2014. So, these guys are washed out. And nothing but a bear market rally. I don't care who you are, you can't argue that. And you might argue right now whether the stock market, the broad market's in a bear market rally, or the bear market's over and it's heading to new highs. That's debatable. What's not debatable is that energy stocks are in a vicious bear market and not even anywhere close to the old highs back from 2014. So it's just a bear market rally. XLU, sell signal triggered, PPO rolling back over right at the zero line like so many things. And then XLRE just gave us, we need to see it close today. It's a daily chart, but you can see the red bar on the histogram, meaning we just had the bearish crossover today. If we close at or below this level on XLRE, that's the REITs. It's not going to move the needle in the S&P 500. It's only about a 3% weighting, but just kind of giving you a bigger picture really of the economy and the market as well as what's going on. Okay, since I wanted to point out the posture of the moving averages, I'm gonna rifle through the same 11 sectors, but much faster this time around, in the same order. Remember, descending order, descending by market cap. So here's XLK, by far the strongest tech. It is above all the confluence. Again, I'm looking at, I turned the levels up so you could see them a little better, a little brighter. The 200-day simple and exponential moving average, as well as the 50, and they're all pinched together there, and it's above. So this is a bullish technical posture. This is the most important sector. So you're going to need to see that if and when those levels go. And I showed you back in the last bull market or bear market, that was common. Tech is very volatile, and it tends to get bought up early on. People love those tech stocks because they have a much higher growth rate. Microsoft, Apple, they're growing a whole lot faster than Procter and Gamble and ExxonMobil and those steady Eddie blue chip companies, and so that's what people flock to during corrections. And the $1 million thing, is this a correction or just first leg down a bear market? But I just want to point that out. So we'll watch those. And again, I can't knock XLK from a technical perspective, but I'm also, like I said, take it with a grain of salt, because that was typical. That's what we saw back in the last bear market. Got above all those MAs and above the 50, 61, 8% retracement levels and all that stuff, and then reversed. XLV healthcare also bullish technical posture. It's been whippy, but it's above those moving averages, so we'll watch that. And again, I'm going to give credit where credit's due. These are the things we need to see go to really open the door for a move at or below those previous lows. XLF, very bearish. Again, this is one of the key sectors in the S&P 500. Here's your 200 days up here, 50-day. It's where it's been rejected at, and it's still below that. So XLC, just testing the 200s right now. So that's a bearish technical posture right now, until unless it can get solidly above those levels. XLY, and again, put a higher weighting on the 200 days, guys, than the 50. The 200s, there it is. It failed at the 200-day simple, just still below the 200-day exponential. So there's bearish technical posture regarding, again, these particular MAs. XLI industrial so far below the 200s, it's not even funny. That got rejected off the 50. So you can see the majority of sectors, that's the point of this video, the majority of sectors are below these key moving averages that often define the major trends, even within bull and bear markets, or during a bear market. That's usually where a lot of sectors rally up to on the initial bear market rally, kiss it, and then never look back. So keep that in mind. XLE, far away from the 200s. XLU, well below the 200s. So you really only have a handful, and the REITs well below the 200s. It's all about tech, and then basic material too, if I didn't cover that, well below the 200 days, both of them. So it's really XLK and XLV, tech and healthcare. that are holding the market up. Not the other 9-11 sectors. 9 of the 11 are down below those key moving averages, which again tell me nothing more than a bear market rally now. And they prove me wrong by getting above those. Then yeah, sure, I'm going to have to look at things through a different lens. Okay, and to wrap the video up, we will rifle through I'll go through the top 17 holdings in SPY. Remember, SPY is also a market cap weighted index like the NASDAQ 100, except it's not nearly as unbalanced. In other words, it's not as concentrated in just those top holdings. You do have a higher weighting in the top holdings, which I'm going to go through here, but then it's not as bad. And again, I'm just trying to paint the bigger picture because, as I say, index is simply a sum of its parts. So you can look at the 11 sectors to try to get a feel, or you can look at all 500 stocks in the S&P 500. But I think if you just look at the top dozen or so, that paints a pretty good picture. So as I said, it's the market-leading FANGs that are holding it up. So not surprisingly, you're going to see a lot of these are still, the PPO is still in positive territory. Looks like we almost had a kiss. We never went negative. So we yet to have that sell signal, that particular one on Microsoft. But we'll watch for that because we're down low. And you can see the last time you had a nice clean separation there. That was a great sell signal. And you can go back in time and, a lot of these, you can see some good sell signals. That's it, kind of still below the previous highs. Apple is zooming a little tighter. One of the stronger stocks. Again, the common theme is the FANGs have been strong lately, and we'll watch. This is something to watch for going forward. Amazon has already triggered a bearish PPO crossover recently, and it coincided, you can see almost perfectly, with that trend line break right there, as I suspected, and some others on the site after earnings. They're selling low margin items. They have problems with their supply chain delivery, where they were having to bump back, only push up delivery of essential items, which essential items are typically correlates to low margin items, people buying toilet paper and hand sanitizer and everything else, like I talked about with Walmart and Costco, and those are playing out already. So look, Amazon is weaker, and that makes sense. A fundamental case could have been made, was made before there, and it still is holding on, and there's a sell signal, both the trend line break and the PPO crossover. But that's only one of the 5 FANGs. Here's Alphabet, still above trend. So these are the levels to watch. Watch these there. Let me tighten up that trend line. You need to see the trend line break. You need to see a crossover, but it's strong right now. As of now, again, no sell signals there. And I'm going to move that trend line like that, like the other one. Facebook, working its way up within this price channel. Very strong right now. Can't knock this stock at all, but we'll watch it. Let's see if we have a downtrend line off the highs, like so many others. We do have a downtrend line coming off the highs or close to it there, so we'll watch that on Facebook as well. J&J, Johnson & Johnson, clean breakdown below the uptrend line. Sell signal on the PPO triggered with a bearish crossover. Again, you had one back here right after that trend line break, so that caught most of that. Walmart, clearly, histograms in red territory after the bearish PPO crossover, broke the trend line, broke that 128 support. Visa, yet to trigger a sell signal. It's at pretty significant resistance, so there's one to watch. JP Morgan, JPM, here's our uptrend line, which is cracking below today. Pretty impulsive breakdown, but hasn't yet given us that bearish crossover. PPO is rolling over just below the 0 line there. So there's one to watch, and we'll keep an eye on the financial sector as a whole. That's the leader. JP Morgan's the biggest bank of all of them. And PG, sell signal there. So you can see kind of a mixed bag. I'm seeing a lot of market leading stocks already breaking down. Others that haven't. Mostly your tech stocks are the ones that have yet to break. So as I often say, when tech breaks, the market breaks, and unless that happens, it's going to be hard for these others to bring it down. It's possible, but hard because of the weighting that tech has. UNH, United Healthcare, poised on any downside. You can see this histogram is right at the 0 line right now, so if we get any more downside from here, that's going to trigger. We already had a sell signal on the breakdown there. We just need to see this trend indicator confirm, and that may mean the top is in UNH. MA, MasterCard, you need to see this trend line go. You can see a lot of these stocks are flirting with that confluence of key moving averages, the 200 and 50s, and that's it. So we haven't had a sell signal triggered yet, but we are at pretty significant resistance, been dancing around this 280 level for a while. Just a couple more to go. Berkshire, well, again, this speaks to security selection. You know, Berkshire is a top component of the S&P 500. And it's one that we shorted, you know, when the case was made for a technical case, and so far so good. We're profitable on that short. We had a nice clean trend line break here, rejection right at that 50-day moving average. And here's another takeaway: some stocks, you know, do a better job of trading off certain moving averages than others. You can see for a while here, Berkshire, that 50 was key support. Once we broke it, it acts as resistance, and it did on that back test. We fell a little shy right here, and then a rejection. So like I said, there's a check mark. Our short looks good, and nothing else to add to that. And that's a couple more. Intel, sell signal on the PPO right there. It's been stalling out, like the broad market, consolidating here. I will say it's holding, trading above the confluence of those key moving averages. So you really need to see Intel get down below this $56 level. I think that's probably the most important level. I know this chart looks like a Christmas tree, but I'm going to color that one up because that's both price support, and it will have taken us below those key moving averages. So that's one, well, certainly a level to watch. Home Depot, right there. Looking good right now, looking strong. I can't really knock it at this point. It's above the moving averages. Verizon, and we'll end it here. This is another short that we have, and again, it's about being selective. So we have the stock market pushing, you know, near the high end of this 3-week trading range, yet the individual stocks within the stock market, the S&P 500 that we've shorted, such as Verizon and Berkshire, they're playing out. And so that's, you know, that's what happens is, you know, you start to see some stocks roll over before others, and those tech stocks are really holding the market up. But you know, as of now, Verizon's looking, you know, it failed at, you can see right at the 200-day moving averages right there, and price resistance is where it failed. And you know, we shorted this one. There's your PPO crossover. This trade, just like Berkshire, is based off the weekly chart, so I'm looking longer term on this one. So again, we're not even close to the first target. You guys could certainly, if you want to, cover there. That's the first support level, about 54.36 if you want to take the quick buck. But you know, this trade, just like Berkshire and some others, you know, I'm looking for a run back down, a test, and quite likely an undercut of those previous lows ultimately. And I may add an additional target there if I see something in the market that convinces me that we might not get to those lows there. I may add an additional target right there. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.